Welcome to our mid-year webinar, and thanks for joining us today. I'm Scott Ronalds, joined with Tom Bradley, and we're going to get right into it. But before we do, just a couple of quick comments on what to expect today. The webinar will run roughly 20 minutes, including some time for Q&A, and we do encourage you to ask questions. To do so, you'll find a box on the bottom right-hand side of your screen. Simply type your question there and hit send. And what we'll do is we'll compile all the questions and answer them at the end of the session. As for the agenda today, we're going to hit on 4 key topics. The first is Brexit and its impact on the market so far. We'll then get into the performance and positioning of the Founders Fund. We'll then touch on our outlook for stocks and bonds. And finally, our advice to clients. So Tom, over to you.
Thanks, Scott. And I encourage you all, when this is over, if you've got some thoughts and feedback or ideas, please pass them on. We're happy to do these if they're appreciated, and we'd like to make them better. So don't hesitate to fire us off a note if you've got a thought on that. Well, as Scott said, we're going to get right into it, and we thought probably the best way to do that would be to talk about what's on everybody's mind, which is Brexit. And Brexit comes really in the context of a year where we've had not just that event, but we've had a number of events. And if you think about just under a year ago, Brexit, whether Greece was going to stay in the European Union, really affected markets late in the summer and early September. And then in the early part of this year, we had concerns about China's growth and stability, and was it going to support a growing economy, world economy. And so Brexit comes with, Brexit comes after those two, and I'm sure many of you are shaken by it all. 08 isn't that distant in the memory, and here we seem to have these constant events. But I would put Brexit in the middle, somewhere between Greece, which I don't think was important at all in impacting your portfolio other than some short-term volatility, and China, which is of paramount importance, and we monitor that constantly, as do our managers. I put Brexit somewhere in between. I don't want to make light of it because, as much as it is sort of a political, short-term, machinations type of event, you know, it will impact what is, I think, a very fragile European and UK economy. And we were seeing, Salman here and I, plus our managers, were seeing some really good signs of Europe starting to pick up, but this could set it back and just delay Europe taking its turn and leading the world in growth. And we do think that's going to happen. It's been 7 years of Europe being flat on its back, but Brexit gets in the way of that. So it's something that we have to watch. As far as the impact, sort of the shorter-term impact, it's really interesting because if you ask people on the street that don't follow the markets, and maybe some of you are in that boat, said how much is the market down after the Brexit vote, they'd say 5, 10, 15%. But you can see from this chart that, yes, it took a real tumble there for a few days, but has bounced right back. This is the broad world market index to just give you a flavor for where the markets are. So stocks are still bouncing around, and we'll see. It's a little early to make any firm conclusions, but they've come back. Where I think we've had a little bit more lasting impact is on currency. This is just a short-term chart to show how the pound sterling took a hit after the vote came out, and you can see, and I think you're all aware, if you're going to London this summer, hopefully you haven't bought your pounds yet, because you'll be able to buy a few more with your Canadian dollars than you could before. The world trade sort of system is really dependent on currencies, and so not only the pound sterling, but the euro is weaker against the North American currencies, so that will indeed make them a little bit more competitive going forward. The other somewhat lasting impact is that rates came down. Quite often in these mini crises, you'll see interest rates drop down to keep the system going. And as much as we saw stocks go right back up, yields have stayed down, and this is the Canadian 10-year government bond chart. it's been steadily moving down, but it was actually under 1% for a period of time, and today it's right around 1%. So it's been good for our income fund. Those of you that hold the income fund will see that it's had a pretty good year so far with rates declining, but we are destined to have very low returns out of fixed income going forward. I think the biggest impact, though, of Brexit is uncertainty. Now, markets always are in a world of uncertainty, but we're going to have some more mini events, some crisis. I'm sure as the negotiations go on over the next couple of years, there may be questions about whether it actually goes through and they honor the vote. So that is probably the biggest impact we're going to have on the market. And generally, we like uncertainty. We can feed off of it and make money off of it, but there may be some contagion from it, and we're seeing that in the banks where there's real concerns about the European banks, and I'm going to talk about that later. So what have we been doing? Well, let me just start by saying we do what we always do, and that's whether there's an event or it's just a nice peaceful day in July, we always have our valuation work right up to date, and I'm talking about our managers on the funds, looking at the stocks and bonds they hold as well as things they might want to own someday. And Salman and I doing it here at Steadyhand for the Founders Fund, we always have a sense of what something is worth, what we're willing to pay, or where we'd sell it. And so as we've gone through an event like Brexit, clearly we have to reassess as the valuations changed. In the case of Brexit, they changed very little. There's maybe a couple of stocks where you could say, well, it severely impacted it, but most it wasn't the case. So then, with that valuation ranges in mind on all the securities, we're able to act if we see opportunities. I will say on Brexit that we didn't do a whole lot. As you saw on that stock chart, things moved pretty quickly. They were down and then they were up, and we're even higher than we were before. But we have done a few things. These are trades we've actually done in the first half of the year, but actually all of these were done since the Brexit vote. We bought a little more Royal Bank of Scotland. We're going to talk about that later. Sanofi is a pharmaceutical company, and we've added to that. Magna, one of the leading auto parts companies in the world, there's concerns about auto sales, particularly with Brexit and a slower growth outlook, and we've added to that. And then I'll let you pronounce this one, the Japanese retailer we bought right at the end of the month as well. So these were stocks where they got hit a little bit. We thought it was unwarranted, and we took advantage of that. On the other side of the ledger is some things we sold in the first half. Most of these weren't related to Brexit, but Ritchie Brothers, the auctioneer company, has had a great run. Medical Facilities is an acute care company held by the small cap fund. It hasn't been eliminated, but it's been reduced. KDDI, the telecom company, we sold out. And gold is one of the features of the quarter. It really led the way, and Franco is one of those stocks that did very, very well. And we've trimmed back on Franco. So as we always do with that sense of valuation, when things get expensive, we're willing to let them go. But in things like Brexit, we're more likely to be a buyer because stocks go below their long-term value. Now, if we look at, pull up a level and look at the Founders Fund, as you know, the Founders Fund owns the other 5 funds in our lineup. And this is what the asset mix looked like at the end of June. Cash and bonds representing the fixed income side with a little bit of high yield, and then Canadian, U.S., and overseas stocks. And we were probably more active in the Founders Fund this year so far than we have in any of the other 4 years the fund's been around. In January, and late January, early February, we took the equity weighting from around 60% up to 66%. And that, of course, was a time when it was very doomy and gloomy, and stocks were being hit pretty hard, and we saw the opportunity to give our equity managers more money to invest, and indeed they did that. And we didn't expect the market to turn around and come back, straight back up, but that was the case as it turns out, such that in the spring, May, and right up to a few days before Brexit, we were bringing back down the equity weighting to a more normal level of 60%. Why? Well, valuations weren't as extremely cheap as they were before. They were more normal, so we got back to a more normal asset mix in the fund. So we've sort of been looking at Brexit and Brexit related, and let's look at performance of the Founders Fund. And when we use the Founders Fund, we realize that some of the listeners here today don't own it. They own the individual funds, and that's fine. It's just a very good representation of what we do and how we're doing, and for the sake of time, we focused on it today. Now, some of you, I've heard you grumble that you haven't made any money in the last year or so, and I know Chris and Lori and Scotty have felt the same way. And indeed, the Founders Fund is up just 0.7 over the last year. Last year's return was 4%, but most of that came in the first part of the year. So it has, as we've talked about with these events, been a much bouncier market. It's one of the rare periods in our 9-year history where we can look and say that you would have been better off over the last year to have indexed your portfolio than been at Steadyhand. The benchmark just represents a similar asset mix to the Founders Fund, but indexed into the market indexes. It doesn't have a fee attached or any commissions like our 0.7 return does, but nonetheless, it was, so far this last year, has been a tougher year on the performance front for us. If I had to kind of characterize it and simplify it a little bit, there'd be a couple of factors. The first one I would say is that the rally here so far this year, since the middle of February, has been very resource-driven. Canadian market is one of the best markets in the world. Been driven by mining, gold, just looking in the stats today, gold index has almost doubled this year. Energy's up, which we have lots of, and this is I say this because this is the kind of market that it's unlikely we'll ever keep up with. And when we have a roaring resource market, we have some stocks, but we're not inclined. None of our managers are inclined to have a full allocation to these more cyclical, in most cases, generally lower quality companies, and so there will be periods like this. We went through this in 2010 as well, where we had good returns, but couldn't keep up with that sizzling hot TSX. That's kind of a minor factor. I think the bigger factor is one that's self-inflicted, if you will, and that is that we've had a lot of exposure to Europe. And so a quarter like this, where we were seeing some really good economic numbers out of Europe and things were coming around, and then had it all come to an end with the Brexit vote, Brexit had an impact on our portfolios more than any of those other mini crises we had, very much so. And specifically, beyond just the broad exposure to Europe, was the bank stocks. So these are 2-day returns, the 2 days after the vote. How's that for short term? But Royal Bank Scotland down almost a third, Paribas 23%, and so on. The European banks, as soon as they had that uncertainty out there, were really hit very hard. And it clearly took the edge off of our performance and impacted our global fund for sure. Now, I'm just going to pause for a minute because you might say to yourself, well, why the heck do we own these banks? Canada's a safe, secure country. We've got a very high-quality, profitable bank. And there are some good reasons because you don't always, as investors, buy the best companies. You won't make any money just by buying the best companies. You've got to assess value. And so why do we like the European banks? Well, they, like Canadian banks, are well capitalized. They're much different than they were in 07 and 08. After 7 years of restructuring, we know all of their dirty laundry, all the warts. There's no more skeletons in the closet. As we've talked about earlier, Europe's been flat on its back and it's starting to gurgle up. Now, maybe Brexit, as I said, is going to slow that down, but as opposed to the North American banks that have already benefited from a booming real estate market, for instance, we've got a lot yet to come in Europe. But the big one is these stocks trade at a fraction of what the Canadian banks trade at. Canadian banks trade at about over 2 times book value, and the companies I showed you in the previous slide trade anywhere, well under 1 times book, some of them as low as half of book. So They're 2 to 3 times cheaper than the Canadian banks. They're riskier. They're maybe not growing as fast, although I think they have more potential in the medium term. But that's why we own them. We owned them before Brexit, and as you saw earlier, we've even added a little bit to them since Brexit. Now let's look a little longer term. Before I leave you, you know that's where our focus is. What we're trying to generate for you is long-term returns. The Founders Fund's been around just over 4 years, and you know, that's a very nice return, 8.7% after our basic fees. So some of you who have either been with us for a while or have larger accounts would have done a little better than that, maybe over 9%. The benchmark, again, has no fees or commissions attached. And really, the fact that we're just matching the benchmark, I think, reflects this more recent period that I've just talked about, because the performance really has been pretty good. Now, I like to show performance that covers a full cycle. We write a lot about this in our quarterlies and things. So I can't use the Founders Fund, but I've picked the balanced income portfolio, which we typically use in these presentations. It's a little different. It's 50% stocks, 50% equities. We've had it tracked on the site since we started, and you can see not quite as fancy a number because we include 08, but this is a full cycle, the good and the bad, just about 6% return after fee compared to a benchmark of just over 5. So $100 when we started our firm is now $167 with all of those bumps along the way. So in the short time we have left, I want to give you just a sense of outlook as to where we're going. And I think if I had to say there's one really big feature in the market today that overwhelms Brexit and all these other things, it's the fact that safety is extremely expensive. And what I mean by that is maybe characterize it by something we all do every day, or not every day, but once in a while, is go into a bank maybe to buy a GIC. If you go in and buy a GIC, you're going to get a yield on it of 1 something. And that's what I mean by expensive. Government bond yields I showed you earlier, almost approaching 0 in North America and negative in parts of Europe and in Japan. So for those who want to go and hide and get away from the volatility of the stock market or other more risky assets, you're losing ground to inflation. And as I say, it is very expensive. Indeed, we have to wonder what we're going to do with our money if we don't want to put it in the bank. And Scotty came up with this slide. I thought this was a dynamite suggestion, actually. But in all kidding aside, if we look forward and think about our outlook, we really think portfolios, because of those low returns from fixed income, has to be diversified. Again, this is the same chart I showed you on the Founders Fund, but not only do we own bonds, we still have some bonds for diversification. We're also having cash to keep some liquidity and available in cases where, like we had with Brexit and the other events in the market. And then a whole diversification or a whole diversity of stocks in Canada, the U.S., and overseas. Now you might say, why stocks? Geez, the headlines are awful. Stocks haven't gone anywhere. And indeed, after a long, very good runs from 2009 up until the middle of last year, I mean, they were due for a pause, but they indeed have gone nowhere in general over the last year. But we think as we look forward that bonds or stocks will return somewhere between 5 and 7% per year. Now this is many of you know we do these 5-year projections really just to give you a sense of what the markets are going to be like. So whereas fixed income, we sort of see the returns being 0 to 3%, 3 being pretty optimistic. This is what we think is a realistic number for stocks. Now you might say, how the heck do we get there given all that's going on in the world and Brexit, et cetera? And the first real element of this is dividends. The dividend yield on the Toronto Stock Exchange today, forget about buying dividend stocks just in general, is 3%. And in Europe markets and overseas markets, it's even higher. So you've got a very good leg up with dividends, but we do think there'll be some growth in the economy over the next 5 years to drive corporate profits. And we say that because energy prices are a huge subsidy to the world economy. Maybe not Alberta and parts of Canada, but certainly the developing world, and Europe and Japan. It is just a huge bonus. Similarly, low interest rates are very supportive. We think the currency landscape, and particularly with the euro and the sterling having come down, it's very rational today. If you think about the two strongest countries in the world, the United States and China, and they have their currencies linked. They have the strongest currencies in the world, and the rest of us have kind of made adjustments to reflect our competitiveness or lack of competitiveness, including Canada. So we think the currency landscape's better. And finally, I tried to pick a word to reflect how strong corporations are today. They've used those low interest rates to finance, and they're loaded for bear. And what we see now out there in the landscape, and I think you all feel it as consumers, and it's not always so great, but instead of 7 or 8 competitors in some industries, we're down to 3 or 4. Pricing is more rational, profitability is more consistent. And so I think what we have to remember when we're investing and we're reading those terrific headlines is that we're not investing in governments. We're buying companies that generate profits over a long period of time, ultimately pay out dividends, and that's what our managers are looking for every day, is to find those kind of things. Now, just to finish, I want to focus on you for a minute, and hopefully you've seen us write about the fact that you are the CEO of your portfolio, and as much as you've delegated a lot of the assignment to us, and we're gladly taking that on, it is still important. You play an important role here. And Scott, you came up with this quote out of the Wall Street Journal that I'm really very fond of. I think things like Brexit, things like the China scare, things like Brexit are reminders that we have to know what we're all about, what we're trying to do, what our goals are, and how we're going to handle these kind of events. Sounds pretty basic, but I think overwhelmingly most of our clients have a plan. They kind of understand where they're going and what they're trying to do, and if you don't, we'd be glad to help you sort of walk through this and think it through. But the biggest part of that plan is what we call SAM, a strategic asset mix. This is sort of that sounds all very technical, but it's the mix of cash, bonds, U.S., Canada, international stocks, et cetera. What makes sense for you longer term? And you know that if you have conversations with Chris or Lori or Scott or David, the conversation always comes back to SAM. What are you trying to do? What is your SAM long term? And so we encourage you to stick to that, and if these kind of events come and they provide opportunities, what we suggest is you rebalance back to your SAM. Sometimes a downturn in the market will take you off your track, and instead of panicking or getting out of the market or do anything, it's a time to get back in. So obviously the name of our company speaks to what we're trying to do, and I think have done very well over nine years. We did it again in June with Brexit, is keep a steady hand on the tiller and keep an eye on the long term. So Scotty, I'm going to stop there, and I don't know if we've got any questions building up here, but I'd be glad to answer some.
We do, Tom. We've had a few come in. Let's start off with one on cash. So the question is, it looks like you still have a lot of cash in the Founders Fund. Can you expand on this?
Well, the cash level has been quite high for a few years, and it really reflects, it is different today, though, than it was a year ago. This time, if we'd done a webinar this time last year, we had 18 or 19% cash, and it reflected a caution towards the equity markets. We really thought valuations were stretched. Our managers couldn't seem to find anything to buy, and so we had an equity weighting under 60%. It was sort of 54, 55 at the time. And we also were light on bonds, because with rates where they are, we do think bonds are a riskier asset class than they used to be. Today, it's a little different, and obviously we used some of that cash early in the year and took the stocks all the way up to 66%, but we're back to sort of a normal level there, and so why I say it's different is because the cash today is more of an offset versus bonds. Connor Clark and Lund is doing a wonderful job in our income fund. They really have. Performance has been great, but there is more risk in the income fund in generating those returns, and so as a bit of an offset and to keep some liquidity for the Brexit type of moments where we need some cash to put to work, we've maintained that cash level. So it's a little lower than it was this time last year, but higher than I would like it long term for sure.
We've got a question on the Global Fund. The Global Fund has underperformed 5 of the last 6 years. How long will Steadyhand wait until making a change in management of the fund?
Well, that's a million-dollar question, really, and there's no assessing managers and how they're doing, et cetera, is not science, it's an art, and we obviously have seen that performance in those 5 out of 6 years. It's been a tough period. We understand why and the strategies they've taken, and we've seen a lot of good things in there, but it hasn't resulted in good performance. I should say, before we say how long until we make a change, I should say that why have we stayed with them? Well, the people we think are very good and have been very stable. Their philosophy stayed the same, and it's one that we think over time makes sense and will make our clients money. They've refined their process a little bit, but it's been very good. So all the things we look for, those hallmarks in a global manager are there, and Salman and I see a lot of managers. We probably average seeing a manager 2 or 3 a week of all shapes and sizes, and this is a firm, Edinburgh Partners, that shows very well against those others. And we understand why they're underperforming right now. They have gone to cheaper stocks, European stocks, Japanese stocks, because they feel the U.S. is expensive. I happen to agree with them. But it has been a trend that has gone way beyond its normal levels. And the gap between valuations on what we call sort of cheaper value stocks versus growth is as wide as we've seen since the tech bubble. So we want to see the other side of that strategy, if you will, play out. And that's why we're being patient. When might we make a change? I can't say. I think it's, we look at all those things, including performance. But undoubtedly, we will make some manager changes over the next decade. I just can't tell you when.
Tom, we have another question, somewhat related. Other than European banks, what are some other areas you're finding value in?
Scott, I think there's a couple areas I'd highlight. One would be energy. We've had a recovery in energy, but in all 3 of our equity funds, and even a little bit in our income fund, we have energy exposure. And as we talk to our managers, Scott and Salman and I, at every quarter end review with our managers what they're doing and what they're seeing, and they're still all pretty optimistic about the opportunity for the energy companies. They don't need $100 oil again, but $50, $60 oil, some of those companies start to make sense and can make some reasonable money. So that would be one area. We really have not taken our foot off the gas on energy, even though we've had a rally there. The other one I just mentioned, Scott, would be healthcare. The Global Fund, for sure, as one of those names on that chart I showed you with Sanofi was the one we added recently. I think their view is that of all the high-quality kind of sectors in the market, almost all of them have got really, really expensive. Healthcare would be the exception. Really strong cash flows. Sanofi is one that has a 4% dividend yield and some growth coming up down the pipeline. So I'd say healthcare would be the other area that we see.
Okay, well, let's wrap it up there. We've gone a little over our allotted time, so sorry about that. But thanks for tuning in, for those of you joining us. And there will be a recorded version of the session available on our website in the coming days. Thanks again.